Welcome to LevFin Insights podcast series, Levered Lines. I'm Luke Miller, Global Editor-in-Chief at LevFin Insights. I invite you to listen to our series of podcasts where we interview key market participants as we look across the main themes impacting the leveraged finance markets. And with that, over to the team.
Welcome to LFI Levered Lines. My name is Kerstin Kubanek. I'm the senior reporter at LFI, and with me today is Allison Davi, co-COO of Benefit Street Partners. Thank you for joining me today.
Thanks for having me, Kerstin. I'm excited to be here.
Yeah, let's just jump right in there. Earlier this year, you announced the rebranding of Alcentra. And given that the fund manager used to be such a household name over here in Europe, what were the drivers behind this decision?
Yeah, it's a great topic for us to talk a bit about because I get that question a lot. And we even had some reporters who asked us for some Alcentra gear. So I know it's near and dear to people's heart, particularly in the UK. You know, it was not a decision we took lightly. Maybe just stepping back a bit to understand the logic behind the acquisition and then how we got to where we are today would be helpful. But if you think about BSP and Alcentra and why we wanted to bring the two together. So BSP, predominantly a US focused private credit asset manager. We were bought by Franklin Templeton 7 years ago. And one of the great things about Franklin Templeton is not only are they a wonderful partner to us in terms of providing us with capital and resources, but they really do believe in allowing their specialist investment managers, particularly on the alt side, to remain somewhat independent and operate that way. So we were acquired by them about 7 years ago, and that was really their initial or more aggressive foray into the alternatives space. Prior to them buying us, I think they had around 15 or 16 billion in AUM. And today in alternatives, and today they have over 260 billion in AUM in alternatives. So there's been this huge progression over the last 7 years, which has really been phenomenal for us to see. The Alcentra acquisition logic was they wanted to create a preeminent global private credit asset manager. And we, BSP, didn't think that that was something we could totally build on our own. Having very little European presence prior to that acquisition, both on the product and on the LP side, really would have made it difficult to do. And so we were extremely excited when Alcentra came for sale because they had a lot of similar businesses to BSP. They were just European centric. So we had a very large US CLO business. They had a very large and successful European CLO business. Those we thought would marry quite well together. We had a US special sits business. They had a European special sits business. We didn't have a structured credit business in terms of a business that buys tranches of CLOs. We wanted to build that, and that was something they had that was already global. And then, of course, from a direct lending perspective, we had a large US direct lending business, and they had a direct lending business in Europe. So that was a big part of the logic behind buying Alcentra, was we had these perfectly complementary businesses that would fit together. There was very little overlap, both in terms of business lines and in terms of investors. And so it was incredibly synergistic. And it would give us, like I said, this presence in the UK, which we didn't have, and in continental Europe as well. One of the misconceptions is that Alcentra was European direct lending, and that was it. Or that Alcentra, the reason we bought Alcentra was for the European direct lending business. That really wasn't a big part of the decision for us. We were predominantly focused on the CLO business in Europe, the European loan business, the structured credit business. Those for us were big, meaty components of Alcentra that we did not have at BSP. So that was the driving force behind acquiring Alcentra. The European direct lending business, we knew when we bought the business that they had been having some troubles. It actually was not on the performance side. Their troubles had come from turnover on the senior management side. And a lot of that was a function of the way they were managed, the fact that they were part of a large bank that owned this alternative asset manager, and they had continuous changes in leadership of that business and on the origination team of that business over the 5 years preceding us buying them, and I think even beyond that. So when we went to buy the entire business, that was actually the question mark for us. They had paused one of their fundraises. They had just had the CEO of that business leave. And so we actually were kind of on the fence as to whether or not that would be part of the acquisition for us either way. And so that wasn't the reason for us making this acquisition. Fast forward to today, we've now owned Alcentra for about 3 years. We are operating on a pretty integrated basis. So we had integrated back middle office distribution pretty much right away. On the investment side, that took us a little bit more time, and we've kept those investment teams mostly separate, but they meet regularly, at least monthly, from a global sharing of ideas and global asset allocation for some of our multi-credit mandates. So we had done a lot of that combination. We had formed a global executive committee. We had these global operating committees, but it was incredibly confusing to the market because they saw Benefit Street Partners, they saw Alcentra. When we would go to conferences, we'd have to use 2 logos together, plus Franklin owns us. It was really quite clunky and confusing to clients. And when we would pitch for these global mandates, people just didn't believe that we were operating as one business. So for us, it became a when, not an if, that we'd become one brand. And it just took us some time to do some recourse and some analysis on the LP side, on the banking side, on our client side to understand, what should the brand be? If it's BSP, is it Benefit Street Partners? Is it BSP? Is it Alcentra? Is it something completely new? And so after doing all of that work, we decided that Benefit Street Partners was what would continue to exist. We've sort of shortened it by calling it BSP, which is what most of our clients know us as. And then I'm sure, you've seen we recently completed the acquisition of APERA, which is a lower middle market European direct lending manager, which we're really excited about. That will be our go-forward direct lending platform in Europe. That is keeping the APERA name, but that may change.
We will come to that in a minute.
Great.
But you also mentioned Alcentra's CLO platform, which has a very, very good reputation over here in Europe. So what does the rebranding actually mean for that specific platform?
Yeah, I mean, the good news is about their CLO business is they actually branded the CLO as Jubilee. So they didn't use the Alcentra brand in the CLO business. At Benefit Street Partners, we actually use BSP in the US. And I'm sure you know this, Kerstin, but Alcentra had a very small US CLO business as well that was under the Shackleton brand that we absorbed into BSP immediately after the acquisition. So those Jubilee names will continue. And I would say I totally agree with you. The brand awareness of Alcentra in the European loan space, in the European CLO business, in structured credit, in European special sits was really very strong. So we did spend a lot of time with our clients really explaining this change, and then with the banks as well. Our view, though, was that the benefits outweighed the potential risks, and moving forward with one brand was really better and more beneficial for the overall firm than continuing with 2 separate brands.
Yeah, and you mentioned APERA, which is different from what Alcentra's direct lending strategy used to be. It's a lower mid-market in Europe. It's relatively niche. It's quite isolated from other direct lending strategies over here. Why did you decide to take that step to move in this direction?
Yeah, it was a big decision for us, and we spent a lot of time canvassing the European direct lending market. I will tell you, FT has been very acquisitive in alternatives over the last 7 years since they bought us. That's where a lot of the growth has come from. And so they see every transaction that is out there. So we spent a lot of time trying to decide, where do we want to be in the European direct lending space? And if you think about it, the market in Europe looks a little bit different than the US, in my opinion, in our opinion. You've got really 3 massive players: Hayfin, Arcmont, Ares. And maybe, Pemberton's getting there, but you've got these 3 massive players that are doing all of the really large sponsor-backed deals in the upper middle market. And then you've got a bunch of other people that are subscale. Alcentra was in a really weird spot. They were a firm that had been playing in the upper middle market before this huge growth occurred, but they had assets and a fund size that wasn't really sized for the place in the market where they were playing. And quite frankly, that segment of the market, given the growth in some of those really large European direct lending managers, it had become quite competitive. So when we looked at the returns in that space for many of those managers, on an unlevered basis, they were getting sort of 6 to 7% net returns, which it's not bad. It just wasn't that exciting to us. So we actually spent a lot of time looking at lower middle market European direct lending managers. We looked at people in both the sponsor and the non-sponsor backed space. We looked at asset backed and corporate. And ultimately for us, the decision to buy APERA was really founded or grounded in the fact that they were a pure middle market player, fully embracing continental Europe. Their average EBITDA is 10 million. And when we looked at why middle market, we were seeing spreads that were 200 bips wide to the upper middle market. We were seeing deals that had at least 2 covenants versus 0 to 1 in the upper middle market. We were seeing recoveries that were also higher on defaulted deals. And so for us, it felt like if we were going to make an acquisition in that space, we wanted it to be differentiated. We wanted it to be unique. We wanted it to be different from the people that had already raised all of this capital. And we've been really happy with that choice.
And are there any other strategies that you would like to expand into, especially over here in Europe?
I love this question because, it's so funny. The private credit space, and this, has changed so much, so much since we were acquired. I've been at BSP for 15 years. And when I first started here, like private credit, maybe we call it phase 1, it was sort of the redheaded stepchild to private equity. And so people were making allocations to private credit out of their private equity buckets. And it was a small allocation, and they were doing mostly mezz or sort of, second lien type deals, but it wasn't a core part of anyone's portfolio. Fast forward 5 to 7 years, and you have phase 2 of private credit, where it becomes its own asset class. People love it. People understand that it doesn't have to have the same returns as private equity, but it's got this really great yield and it's got J-curve mitigation. And so there's a benefit to having it in your portfolio. We lived there for a long time, and most of what people were allocating to during that time period out of that bucket was regular way direct lending, sponsor, non-sponsor, upper middle market, lower, US, Europe. That was the focus. If you fast forward now to today, well, maybe today, a few weeks ago, before all of the news around the semi-liquid structures, but if you fast forward to 2026, what we started seeing towards the middle half of last year in a really meaningful way was that allocators were saying, we've made our core allocations to direct lending. We want to diversify. So we want other strategies, these sort of bolt-on strategies that are unique or different than what we have in core direct lending. And so we saw that when we were in the market last year on a real estate debt fund, which 5 years ago when we tried to raise the first one, it was very painful to get people to give us money because they just didn't know where real estate debt should sit. And last year we were oversubscribed. So there's this desire to invest in asset-backed strategies, in more esoteric strategies, in strategies that have risks that are different than corporate direct lending. And so we really tried to embrace that. We viewed APERA as being differentiated in that it was lower middle market and Europe. And we are actively spending time on the asset-backed space, on healthcare lending, on things that an infrastructure debt, on segments of the market that we feel are less competitive and, again, allow people to expand their private credit exposure horizontally.
And if we just take direct lending as a very specific strategy in the private credit space, currently everybody is a little bit nervous. Well, a little bit, some people panic outright about AI and software and tech and whatnot. What's your take on what's your house view on that situation in the market right now?
We've spent so much time on this. It's funny. As we were recording this, we are doing a webinar at the same time with 300 investors around this exact topic, sort of this exact topic. But you're right. You've seen a lot of headlines, particularly in the US, where these semi-liquid products have really taken off around a combination of AI and private credit bubbles and redemptions, right? They've all sort of come together. And so we feel like some of this is based in truth and people should be concerned, and some of it is a bit overblown. So if you kind of look at the 4 things that people have focused on, one is all of this noise around frauds and valuations and bubbles. So, First Brands, Tricolor, MFS, there have been a bunch of credits where either fraud has been discovered or in a very short time period or the asset has gone from 100 to 0. And people have concerns about that. I think that's not specific to private credit. Fraud is obviously something that happens anywhere. I will say they've all been, I think, almost entirely asset-backed deals. And those transactions are much more challenging to monitor and understand because you're often providing credit to a portfolio of securities. So there's kind of more that can potentially go wrong. And so I would say, while that's a concern, I don't think that's a private credit specific concern. So that's the first one. The second one is there have been concerns about, rates going down. And so will that impact absolute returns? Yes, we've been here before though. And it also lowers the cost of leverage. It, improves companies' abilities to repay their financing. So for us, spreads and rates have gone up and down a lot over the last 15 years. And that hasn't been at odds with the asset class's growth. What we look at is how much of a premium are you getting to the liquid markets, and is that persisting in that 100 to 200 bips range? And if it is, you tend to still see demand for the asset class. So that's the second. The third is all of the noise around the semi-liquid products, which I do have some concerns about. I don't think it's entirely fair given those products, and just so you know, we have less than 8% of our assets under management are in semi-liquid. We missed the semi-liquid wave. We don't have a ton of capital in that space, so I have no skin in the game really. But I would say, those products are labeled semi-liquid. They do have 5% quarterly gates, which is the way the products should have been sold. Whether they were sold that way or not, I don't know. But I think this idea that people are quote unquote gating when they're actually providing the requisite liquidity is a little misleading, and it is causing this continued panic and an increase in redemptions. Now, should private credit be offered to retail investors? I think so. But if people really want true liquidity, the way you get liquidity in a mutual fund or an ETF or traded equity, this is not the right product for that. And hopefully this will kind of weed out some of those investors, but I don't think, the asset class is going away for retail. So the last one is your question about software and AI and how this impacts private credit. I do think we're all seeing this. AI is disruptive. It's changing the way people do things. It's going to be particularly disruptive to the software space first and foremost, and there will be other sectors of the economy that will be impacted as well. Private credit as an asset class has been over allocated to software than other asset classes. If you look in the private credit space, I think what we're saying is it's 20 to 25% exposed to software, even if they're hiding it in other buckets like business services. And that compares to maybe leverage loans in more of the 15% space. So there is a real risk because some of those software companies will cease to exist. And these ARR loans that people underwrote in 2021 and 2022, may not actually at some point be able to repay the debt that they've taken out. Now, the only comfort I sort of take in this is that most of those deals were done at monstrous valuations by private equity firms who put up quite large quite large equity checks so that loan to values were actually pretty low, even though the leverage was quite high. So you do need to see some real impairment on the equity side before you see true impairment on the credit side. And I think private credit has been bearing the brunt of the news because of all these semi-liquid vehicles and because they publish individual investments, and we just don't have that same transparency in private equity. So I think it's going to be disruptive to both sectors. We're underallocated to software, so I'm hoping it's less disruptive to us. But it's that to us is the one piece of news that has some real merit and will likely impact how various private credit firms perform over the next 5 years.
Thank you very much for your insights. Very interesting indeed. Thank you so much.
This podcast should not be copied, distributed, or reproduced in whole or in part. Neither LevFin Insights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. LevFin Insights is not providing investment, legal, accounting, or tax advice. LevFin Insights is not providing research or making any recommendations, nor is LevFin Insights offering or soliciting any transaction with respect to the purchase or sale of any security that the listener may hold.